the secret to more tax-efficient withdrawal strategies? And how do we make it work in a smarter way? Well, we're here with an amazing expert, Jennifer Hutchins. Give us a little guidance here today. Jennifer, welcome. Thank you so much for joining us today.
Absolutely. Thank you for having me.
So now we've heard for years that the 4% rule is dead, right? But when you look at dynamic withdrawal strategies, what's the single biggest shift advisors need to make to protect clients from sequence of return risks early in retirement?
Sure. I think it's about pivoting from thinking about a static approach to a more dynamic or flexible approach. And it really has to do with understanding the needs of your clients, right? If 4% is just not enough for your clients for whatever reason, then migrating to a more flexible strategy where you put guardrails in place, I think makes sense. So, for example, Morningstar recently did a study. They actually found that the new quote safe rate is 3.9%, so even a little less than 4% these days, over a 30-year time horizon with about a 30 to 50% allocation to equities. Now, if we look at some of the methods out there that give us some flexibility for that base rate, one of the more prominent ones is the Guyton-Klinger method, which allows for flexibility during drawdowns where you can trim your income by about 10%, but then give yourself an increase during up markets. The Vanguard method is another method where you have ceilings and floors for increases and decreases. And the study actually shows that when you do those flexible methods, it increases your base rate to just over 5%. So again, I think it goes back to trying to maintain that flexibility and really setting that mindset up front with your client, because honestly, that's the hardest part, is the behavioral finance of continuing with that flexibility and fluctuating income.
So tax efficient distribution, it's sequencing, it sounds great on paper, right? But when you have all of these logistics, all these different accounts, Roth, IRAs, et cetera, it can be a logistical nightmare, right?
Absolutely.
How do you kind of decipher this to make all the sequencing work perfectly for clients?
Sure. So I like to keep my playbook very simple. I like to keep a default method with some trigger points where you break that rule, and then ultimately give your team a decision tree so it makes it simple for them. So if we start with the default rule, normally you're going to pull very simply from your taxable accounts first, and then your tax-deferred accounts. The trigger rules that I like to think of, or you break your rule, is when you have a year when a client might be in a lower tax income bracket. And maybe that's because they retired early and they haven't started Social Security, maybe they had a business loss, maybe they have a gap year. For whatever reason, you would want to pull those assets from your traditional IRA to fill up that lower tax bracket. Another reason that you might break that basic default rule is if within your taxable account you have a security or an investment that has significant appreciation, and you've decided that you're going to bequest that to your heirs upon death. Well, then you should work around that, leave that for them to get the step up in basis, and then pull from one of your tax deferred accounts. Now, the next step, the decision tree, which I really think is the most important part to make it simple for your team that supports you. You have some basic rules for first pulling from the traditional IRA. Again, we're going to go back to the lower tax bracket. If you find yourself in a year where you're in a lower tax bracket, use it to your advantage. Pull from that traditional IRA. Also, if you have a younger client that is retiring and wants to avoid some of those higher RMDs later on, go ahead and pull from that traditional IRA as well. And then finally, if you know that your heirs are going to be in a higher tax bracket than yourself, help them out. Pull from that traditional IRA and bequest them the tax-free funds. So, and when we think about the Roth perspective, it's really the flip side of that. Number one, if your heirs are in a lower tax bracket than yourself, let them pay less taxes than you would have to on that traditional IRA, and you pull from your tax-free funds. Also, if you think that you're going to have a larger medical expense as you get older towards the end of life, pull those tax-free funds now so that later in life when you pull from your traditional IRA, you'll have those medical expenses that will offset the taxes you'll pay from that traditional IRA.
So now you have someone who listened to all this, they're intrigued, they're interested. what's the best first step? What's the takeaway that you want to make sure that they heard from our conversation here today?
You know, that's a great question. Honestly, the takeaway is, if you don't leave with anything else but this, remember that you're not selling portfolios, but rather you need to begin engineering a paycheck for your clients. Because really what we've talked about, you know, the income, knowing your client, is it 4%? Do you need some more flexibility there? Then we move to the very simple default, break the rule, decision tree, the sequencing of distributions. And then you want to retain those assets. You want to engineer that paycheck. Because at the end of the day, the clients don't live off of a portfolio, they live off of the paycheck that you give them. And if you're giving them a tangible paycheck that supports their needs in the end, they're not going to go look for another advisor to work with.
100%. Jennifer, great insights. Thanks so much for joining us today.
My pleasure. Thank you so much for having me.
For Wealth Management, I'm Matt Ackerman.